Losing scalpers trade with lagging indicators like RSI and moving averages. Professional scalpers read order flow and market microstructure with tools that you've probably never even heard of. Here are 8 scalping techniques that separate losers from professionals. Mark the previous day's high and low, then watch how price interacts at those levels. This area often works like a magnet, drawing attention from both buyers and sellers. You want to monitor if price breaks this key bounds or rejects them. Scalpers keep their eyes on these breakouts, looking for a quick burst. A successful breach can lead to short-term buys. If the break stalls or fails, they may close out fast, expecting a slide back into the day's range. That same logic applies to the previous day's low. If price pushes below that point but struggles to go lower, it might climb back, sparking quick trades. Volume flow at these points shows who carries more weight on the chart: the group ready to push higher or the group ready to defend and revert price lower. For instance, day traders might sit with a wider view. If volume fails to rise and the price breaks, they see that as a weakness. That could hint at a chance to fade the move, expecting a drift back into the range. In a bullish setting though, a clear break above the past high might signal bigger gains. Again, wait for retests of these highs or lows to confirm support or resistance. A strong surge suggests bigger participants stepping in. A weak spike suggests the break might not hold. Another interesting strategy is to mark highs and lows from multiple days to see confluence. If many past highs cluster in one region, that marks a bigger level on the chart. Order flow analysis also builds on these zones. In a bullish flow, price may seek buy stops above a prior high. When price drives higher, that might feed more buying interest. In a bearish flow, it might head for sell stops below a previous low. If momentum keeps running, price extends further. If it fails, it can whip back. Footprint charts split each candlestick into 2 columns of executed orders. One column shows the volume on the bid side, and the other shows the volume on the ask side. This view helps you see who might be more active at each price level. In a strong rally, the footprint can reveal if buyers are pushing price upward in a steady way. In a strong drop, it can reveal if sellers keep hitting the market with large orders. This method is direct and numeric. A footprint chart doesn't rely on a guess about patterns. It relies on actual trades. Each block of traded contracts or shares is visible at each step. Imbalances come into play here. An imbalance occurs when one side greatly exceeds the other at a given price level. On a footprint chart, that might appear as a large difference between the bid side volume and the ask side volume. This gap can hint at which side is more aggressive. It can also reveal if big participants are stepping in with size. In a fast-moving uptrend, repeated buy imbalances can reinforce the bullish pressure. If you see repeated sell imbalances, you might guess that big participants are forcing price lower. At key turning points, footprints might show signs of absorption. Absorption means one side is absorbing the other side's orders. That can appear on the footprint if you see big numbers on both sides, but no real progress upward. In an uptrend, a footprint might reveal hidden pockets of supply if the bars show large sell imbalances at certain levels. That might stop the move. The idea is to watch the actual fight between buyers and sellers. The footprint is a lens into the order flow. At times, the footprint view can show that even in a strong uptrend, large sell orders keep popping up at certain levels. Price might stall there. If the volume on the buy side absorbs those sellers, price might break higher anyway. But if large sellers hold that line, price might turn. The footprint chart helps highlight these battles. A normal chart might show a candle with a wick, but the footprint might show that this wick printed huge trades on the left side. That can sometimes mean a sudden wave of sellers. For day trading or scalping, footprint charts are a must. Some charts show hidden pivot clusters. These clusters happen when 3 or 4 pivot highs or lows stack near one price. I personally like to watch to see if price builds a block of these points. Price might respect these zones. It might hit that band and pause. It might bounce off it or break through. These clusters can matter to many group of traders. And I try to keep my chart structure simple. If there are 3 or 4 pivot points in the same neighborhood, that can form a hidden cluster. If I group them together, I see a stronger band. This can help me spot places where price might react. I treat these clusters like wide support or resistance zones. They are not exact single lines. They are areas on the chart. Sometimes these clusters coincide with pivot points. Many day traders and scalpers use daily pivot formulas. If a cluster lines up with a pivot calculation, that might strengthen the zone further. It might bring more eyes onto that spot. That can create a self-fulfilling effect, at least for a short time. I also look for clusters that might be hidden inside candle wicks. The market spikes up or down and leaves a wick. That wick might mark a pivot high or low. If I see multiple wicks that poke into the same area, I might highlight that as a cluster. The candle body closes might not show the same price, but the wicks might. That can still matter to me. If price returns there, it can trigger a new burst of activity, or it might hold as a barrier. I also consider how wide the band is. If the pivots are spread over a big range, it might be less precise. If the pivots are very close together, the cluster might be tighter. Tight clusters can create sharp reversals because many orders might be loaded at nearly the same price. Wide clusters can lead to choppier action because price might drift within that zone. Some see clusters of pivot highs as zones full of potential sell orders. Clusters of pivot lows may hold buy orders. That might be because each pivot left a memory in the market. Some participants may have open orders there from before, or they see that zone as a logical place to set stops or limit entries. This is why these clusters can become magnets. TPO stands for Time Price Opportunity and is a great tool for scalping and day trading. A TPO chart displays time at price in a ladder-based format. These charts break down each time frame into ladders. Each ladder aligns with a price level in that time frame. One advantage of TPO charts is how they strip away messy candle wicks. Instead, you see a clean layout of time spent at each price. A bar chart might show big upper shadows or wide intraday ranges, but it can be unclear how much time was spent at certain levels. TPO charts reveal that detail. If you see 10 letters at one level, that means 10 distinct time blocks spent some portion of trading at that price. That is a direct way to sense how the market balanced or tested each zone. If the big cluster forms around the middle of the day, some interpret that as a balanced session. When you see the cluster push up near the top, you might sense that participants welcomed higher pricing. If you spot a cluster near the bottom, that can mean persistent acceptance at lower levels. A short stack of letters at a certain price might show that the market tested that level, but quickly moved away. That might reflect swift rejection. If the price tried to stay there, you would see more letters added. If you see only 1 or 2 letters, that can mean the market spent just 1 or 2 time blocks there. Some traders place special importance on single TPO prints at extremes. That single print might highlight a strong rejection. Market profile watchers may call that a sign that the market poked into that territory, found no willingness to trade, and reversed. Rejection becomes visible because the chart never built a tall column there. The middle area often becomes the point of control, referencing the price level with the most TPOs. In many sessions, the distribution might not be symmetrical. It could skew higher, or it might skew lower. That tilt can show that either buyers or sellers took control for much of the session. In an active bullish scenario, you might see a heavy cluster of letters near the top. That can hint the market accepted higher prices, finishing near the highs with a strong cluster. In a bearish environment, you might see a thick cluster near the lows. That can mean repeated trading activity in that lower region. People also track the value area in a TPO chart. The value area often covers the price range, where 70% of the day's TPO activity took place. That area is presumably the day's fair zone. Day traders watch the open in relation to the prior day's value area. If the market opens above it and keeps building ladders at higher levels, it can reflect bullish acceptance. If it drops back into the previous day's value area, that might show a failure to sustain new ground. Combine a trend line with a volume spike test to see how price reacts on each retest. Draw a steady line through points on your chart. Then watch how volume changes each time price touches that zone. Here we have a rising line under price. Suppose price taps that line more than once. Track the effort behind each tap. If volume expands at the contact point, but price does not break lower, buyers might be holding the line. That reveal can guide you to think buyers are present despite the test. If price closes firm above the line, that hints that buyers outweighed sellers, so the uptrend may continue. On the other hand, imagine volume spikes at the trend line as the price breaks. The line can become a weaker barrier. A strong close beyond it can mark a firm change. Sometimes you see a wide bar pushing through that line with large activity and no bounce on the retest. That scenario often signals a real shift. You might see a giant volume bar as the final push, and price continues well below the line. That can warn that sellers stepped in aggressively. The line no longer stands in their way. First, test your approach on past charts. Open a chart and draw your rising or declining line. Then wait for price to drift there. When it does, watch the volume level. If volume exceeds the average by a visible margin, see how the candle closes. Does it close well above the trend line or below it? That single data point can speak volumes about market intent. Watch for sideways drifting near the line. If price stalls near that line and volume bars climb, that might suggest big players are building positions. Price might then explode above or below. A strong breakout with a wide range bar plus large activity can confirm the path. A breakout with low volume will often fade. Observing the spike helps you see if big participation is present. That is the advantage of combining a trend line with volume spike tests. Examining each bar's range is a simple way to see if price might break free or stay quiet. The gap between the bar's high and low reflects market energy. A bar's high reveals how far buyers try to push. A bar's low shows how far sellers try to push in that same period. That difference in height, known as the range, can show if the market is slow or alive. A big range can hint that traders are pushing and pulling with greater force. A small range can point to caution or waiting. This practice is called range analysis, and it starts with reading each bar in a straightforward way. It does not require fancy tools. A day trader looks at the bar on the chart, notes the distance from high to low, and compares it to prior bars. If the new bar towers over the one before it, that can be a sign of more volatility. If the new bar is smaller, that can be a sign of reduced action. This is a direct and practical way to gain insight. Range expansions can show that something has changed. A large bar might mean that many players jumped in during that period. Traders holding positions could have strong opinions on direction. That strong opinion can create a surge. When price covers more ground, it can catch some off guard. Some might see the big bar and believe the market is on the move. Others might step aside, not wanting to fight that momentum. Contraction is the opposite. When bars get smaller, it might show that traders are waiting. They might not see a clear path. The highs are not too high. The lows are not too low. That can create a cluster of narrow bars, each one marking a slim distance between high and low. Some traders anticipate a breakout from such quiet stages. They keep watching for that first big bar that bursts in one direction. That bar can bring energy, hooking new orders into the market. Others remain cautious, unsure if the quiet phase will continue. Sometimes the quiet phase drags on, frustrating those who wait for a spark. Seeing expansions or contractions in the bar range helps judging market tempo. It shows if the market is active or calm. This direct reading helps keep the focus on price. Of course, you must pair it with volume data. You want to see if the wide bar also had high volume. That's strong commitment from big players. Candle close location value shows how each bar finishes relative to its high-low range. If a candle closes near its high, buyers kept pushing until the end of that time frame. If a candle closes near the low, it shows larger selling pressure toward that bar's finish. A close around the midpoint marks a balance between buyers and sellers. Day traders watch these closes to see who seems stronger over a series of bars. If many bars close near their highs, it can hint that buyers are consistently winning. In an uptrend, a streak of bars that finish high suggests strong interest at each step. If a bar suddenly closes near its low after that streak, it may point to a shift in mood. This 5-minute chart shows consecutive closes near the top. That can mean buyers are active on each bar's final trades. If the next bar closes deep in the range, watch if buyers step aside. If that low close coincides with wider ranges or bigger candles, it might reveal a sudden wave of selling. Candle close location also helps you detect subtle shifts. Suppose a market moves upward, but the candles start closing near their midpoints, creating shadows on top. You might guess that sellers are active, even if price is still climbing. Over time, those repeated mid-range closes could foreshadow a stall. On the flip side, a market in a downtrend that begins closing near the high of each bar might show stronger buying than before. Traders sometimes calculate an average candle close location over a set of bars. If a candle closes near its high, its value is 1. If it closes near its low, its value is 0. If it closes in the middle, it has a value of 0.5. Then you consider average value on over a set of bars. If that average stays near 0.8, for example, bullish pressure is steady. If it oscillates around 0.5, the market looks indecisive. A swift drop toward 0.1 can point to a big change in tone. Candle close location is straightforward and thrives on raw price action. That direct view can help you sense if momentum is building or fading. Identify a measured move to see how price might extend in a trend. Picture a market that rises a certain distance, then pulls back, and then drives higher again. That distance from the first surge often helps you estimate how far the next wave might go. You take the size of the first move and project it above the pullback. This is a measured move, a quick way to guess a possible target. If the market meets that target and stalls, That might confirm the measured move idea. If the market blasts past the target, that might reveal extra strength. Imagine a clean uptrend. Price rallies 100 pips from a swing low. Then it retraces about 50 pips, forming a short pause. Now price moves up again. Some traders measure that first wave and plot that same distance from the swing low of the pullback. That new level becomes a reference. They watch if price hits it or not. This approach feels basic, but it can help you map out expectations. You look for symmetrical movement in a trending environment. If a market makes a series of waves that mirror each other in size, that might confirm the trend has a steady rhythm. If you see multiple measured moves that keep playing out, you get a sense that the trend is healthy and consistent. Of course, markets don't always honor the symmetrical moves precisely. You might see it come close, then fade, or you might see it power right through. Measured moves aim to give you a ballpark estimate, not an absolute rule. But this concept can also help you with risk assessment and with your targets. This is a simple chart geometry approach. You measure a prior leg and replicate it. You see if the market respects that geometry. So use symmetrical moves to project possible targets, and then interpret it if the market exceeds or falls short of that measure. If it overshoots, it might be a sign of strong momentum. If it undershoots, it might warn that momentum is weaker than before. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.